Hello, my name is Mark Carrington from mybitcoinprofits.com. Last week I presented an analysis of Bitcoin against the US dollar from a purely technical point of view. And at the end of I said I would not be a buyer of Bitcoin from a technical point of view at the current levels until I had seen clear signs of reversal. The chart in front of you, I have a Bitcoin against the US dollar chart. It's a daily chart, as we can see here. And the market data is from Bitstamp, which is one of the largest market datas. And I said the reasons to take the trade, just in summary, is we have a clear uptrend here on the daily. The price remains in an uptrend. We've had a pullback to a significant Fibonacci level, so you will recall these are the Fibonacci lines. It's taken from these lows here through to the highs here, and it produces a series of Fibonacci numbers, and the significant levels are 0.618 and 0.786. And I have marked on the chart a rectangle, which is for me the buying zone. So the buying zone here is we've seen prices come down into the buying zone and is now, so that's when I start becoming interested. There also is some horizontal price support at this level. This red dotted line here goes through the horizontal price support. It may not look as if it's going through the lows for this last period of consolidation over here. It is certainly going through the lows here, but if I change this to a line chart, you'll see that what I've done is I've actually drawn the line through the bottom of the closes for that. So that clearly shows me where the reversals are based on the closes. So that's why that line is there. So those were the reasons to take the trade, or to consider taking the trade, and I was looking for clear signs of reversal. And clear signs of reversal is basically when we're waiting for the trade to move this way, I want to see price making higher highs. And as I go in here, so remember, and I will also talk about this bar being a very large bar, so we need to see this going sideways. So the bar after the large bar, it was a buyer bar, so the close was near the top of the bar, but it only went halfway back. And the bar after that was a seller bar, so it made a lower high. The bar after that made a lower high, and the bar after that made a lower high. And they each made, after the first one, that's made a lower low, and this one's made a lower high. So here we have the first sign of a reversal is that we have a bar which has made a higher low, but it did not make a higher high. So I'm not interested then. This bar then becomes the interesting bar. And you could have during the course of the day, because the bar is opened here, it has gone down and has run up. During the course of the day, one could have pending order above this bar where the line is, above this bar, and would have been in the trade. The question now then is that this bar here is now clearly a reversal bar. It's called a bullish engulfing bar because it's taken out the low and then the buyers have taken charge. So from a technical point of view, one could put a trade in here above this bar and say, I am going to be interested if the market continues this trajectory upwards, because it's demonstrated that it wants to do that. Now there are a bunch of things here that would make one a little bit uncomfortable, and I call those reasons not to take a trade. The first of those reasons is that if we go back in time, this high here was lower than this high here, which was lower than this high here. So we have 3 consecutive attempts to break through this level, which is around the $475 mark, $470 mark, and the market has failed to do that. So if I draw a line in here from that top through there, we'll see that we are actually sitting in the middle of a triangle. Let's remove some of these things here so it becomes clearer to see what's actually going on. So for the most part, I am only interested in making trades when we break out of a triangle. That's from a purely technical point of view. Now there are a few other things in here that we oh, I didn't mean to move that line, but that's fine. I said reasons to take the trade. RSI and the stochastic indicators are moving from oversold. So these are indicators that are calculated on previous prices, which tell me about the momentum of the trade. So let's put RSI, which is the relative strength index, and basically what it does is it measures the rate of change between successive closes. And I'll put in the stochastic, which basically does the same thing. They have slightly different time frames. The noticeable part about both of these indicators is that there are markers here. These are marked at 70.30 on RSI. That's the top one. It's on a 14-day RSI. And the price typically runs down and it reaches the point and turns around, and then we get interested. These are called, this is oversold. So as it happens here, the price at the time of that big down bar, the market was showing that it was oversold. Momentum was showing it was oversold. And you see the same on the stochastic bar. The hidden in here is the other reasons I am nervous about making this trade long. You'll see here we have these highs. They made slightly lower highs, but essentially they're a flat. And we'll see that on the RSI we also have declining highs. This is an indication the market is running out of momentum going upwards and it wants to turn down. Now these are not my favorite ways of showing this momentum. I prefer to show that using MACD, so I'll get rid of the stochastic and I will put the MACD indicator on here. And we will see if there is this divergence between these highs, basically these two tops here, and there certainly is divergence here. So the market is telling us that there is a risk that this is going to turn down. Now what we'll actually notice is the MACD has actually now turned. You remember the last time we looked at it, the MACD had now crossed below zero, which is a bearish signal, and it is now turned, and there's potential that it is heading upwards. So there is a reason to consider a trade long, but because of this divergence, I would tend to take that trade at half size. So that's purely from a technical point of view. The challenge in taking this trade, if we're going to go in above this high at $424, our stop loss needs to be below this last ring low, which is 346 or $345. That is a stop loss of $75. Now $75 divided into 340 something feels to me like a 20% stop loss. So that is a significant stop loss, and that's just too uncomfortable for me even at half trade size. So what I would prefer to see is this continuation inside this range, where we can eventually get a ring low like this to provide a stop loss and an entry point based on some sort of reversal that gives me a trade size that is not so large. I would also far rather be trading when the price does this, breaks that uptrend, that downtrend line, proves that it wants to go up and starts going over there. And because of the size of the gap between these two lines, I might consider a trade that when the trade breaks down like that, onto this lower trend line or onto this horizontal support line, and I can get an entry there. Thanks very much.